Hello and welcome to the Safri Private Wealth Podcast. I'm Leonora Stevens, a private wealth partner based in Bristol. I'm joined by Mike Hodges, a fellow private wealth partner based in our Manchester office. Hello, Mike.
Hello, Leanne.
Join us each episode for in-depth discussions on private wealth matters, from estate planning and trust to retirement and gifting strategies. We're here to provide practical tips to help grow and protect your wealth. And please don't forget to subscribe on your preferred podcast platform. Today, we're talking about key dates and deadlines for 2026. This will cover off a range of topics to be aware of, such as pre-end-of-year tax planning for 25-26 and making tax digital, known as MTD, and where action may need to be taken in advance of the 5th of April 26 to help mitigate tax, or systems that you may need to set up to aid with your reporting requirements. Before we launch into the bigger topics that have been keeping advisors busy for the last 18 months, for example, inheritance tax, I thought it would be useful first to cover off some of the rate changes will be from April 26, and therefore where clients may want to do some planning now. So firstly, one sort of an easy one to look at is the dividend tax rates. So for basic and higher rate payers, this will be increasing by 2%, where it now is 8.75% will go to 10.75%. And the higher rate will go from 33.75 to 35.75. The additional rate of tax on dividends will be 39.35, and that will remain the same, so that won't change. So what does this mean for clients? If all your dividend income is already taxed at the additional rate of tax, it won't impact you, so you don't need to worry. But if your basic or higher rate bands, you may want to consider whether you should take dividends out of your company before the end of the year to mitigate that increase in tax that will apply from April 26 onwards, where the tax will be higher. So you might want to consider some planning before the end of the current tax year. The other point is on business asset disposal relief, known as BADR. And we've discussed this before, and this is quite a valuable relief, which reduces your capital gains tax where you have a qualifying disposal of a business interest. For BADR, there was a reduced rate of CGT applied to the first £1 million of gains that you'd realise on a qualifying disposal. Historically, this rate was 10%, and then it increased to 14% in April 25, and now it's going to increase further to 18% with effect from April 26. So you might want to consider whether you can accelerate any of those disposals before the end of the tax year. Business asset disposal relief, or historically entrepreneurs relief, was the rates have changed, the limits have changed, but I think this is just a way of them phasing it out pretty much completely. There are other changes that are coming in from the 6th of April 2027, which people might want to start thinking about as to how they can mitigate that, where we've got an increase in the property and savings tax rates. So the rate of income tax will be going up by 2% across the board when it applies to basic, higher and additional rate taxpayers. And so say that's something to consider, especially when you're thinking about repairs perhaps, and which taxes those would fall to mitigate that increase. The other area where we have had a lot of queries from clients and lots of discussions is about pensions. From April 2027 onwards, people, if you were to die with a large pension pot, that would then be subject to inheritance tax. This has caused quite a lot of upset with clients who feel that they have worked very hard for many years to provide this tax-free pot for their next generation. But so we've been discussing with them as to whether they take their tax-free lump sums. Do they withdraw the funds over a period of tax years to create a surplus income so that they can give this to their children? But what I'd recommend is where clients are affected by this, speak to their pension advisor in the first instance, and then also talk to us about the tax implications and to allay those fears if we can. But Mike, I've covered off a couple of the rate updates or key changes. Do you want to include some of the practical points around other year-end planning that might be useful?
Yeah, so hopefully our regular listeners have absorbed and taken action on the APR and BPR changes which are coming in from 6th of April. So at the time of recording, not so many weeks off. But I've got one or two clients who are still in that process, but now time is getting tight. I think the thing that has changed, or potentially the two things that have changed on that since we last covered it, the announcement on I think it was the Monday before Christmas, that the £1 million was going to become £2.5 million, which would take quite a bit of the sting out of these changes coming in. And the fact that that allowance is now going to be transferable between spouses. So that's good news. But if you've done your planning, I guess, because we're close to the deadline, that the thing then is not to forget, and this is where your tax advisor obviously will help you, all of the returns that need to be done. So IHT returns, which are typically 6 months after you've done whatever you've done. So if you're taking assets out of trust or putting them into trust, depending on which way you're going, CGT holdover relief claims, all of those sorts of things. And we were discussing in the office the other day because we're very good at doing transactions. And I always say to my team, just write it down on a piece of paper. But within days, you've forgotten. Well, if you're like me, you've forgotten what you did. So you need that record, because then when you are doing the reporting, it's much fresher in your head. So lots of the fairly mundane stuff. And if your planning involves new trusts, then there's the whole trust registration regime that, again, people mustn't overlook. So make sure those things get picked up. As I say, fingers crossed your advisor will talk you through all of those things.
Thank you. Yeah, well, I say that I think that the IHT has been a huge area of discussion for us over the last 18 months to 2 years. And so, as you said, I do feel like it has, a lot of people have done the majority of things that they were planning on doing anyway. So
I think so. Or they've done the thinking and then we're now in the final throes of implementing, by and large.
Apart from the IHT changes, we have got quite another big event coming down the road for clients and us called Making Tax Digital. Do you want to briefly sort of cover off what this means?
Yes, this has been in the wings so long. It's got almost mythic status, hasn't it? Because you thought, well, is this ever going to happen? And now it is. So from the 6th of April, certain people, and it's by no means the majority of taxpayers, but self-employed and landlords, sort of simplifying a bit, but that's broadly it, will have to keep digital records of their income from those sources and make quarterly returns. So we've now got a whole 4 new deadlines, because they're quarterly returns, submitting on the 7th of August, the 7th of November, my wife's birthday, the 7th of February, and the 7th of May. And those are just so peculiar as dates. They just don't resonate at all. So it takes some getting used to. I think the whole MTD thing will take some getting used to, both from our side, taxpayer side, and from HMRC. And I think this is all part of tax gap planning, because HMRC each year publish figures, or the Treasury publishes figures that show there's a tax gap, the difference between the tax that they do collect and what they think they should collect, of somewhere in the 30 billions. And one of the areas that they've identified is the time delay built into what we're used to in terms of self-assessment tax returns. This is the first step in trying to reduce errors and make sure that people's records are more real time.
I think that comes back to your point, actually, what you just said earlier when we were talking about making sure you note down the transactions as they happen from our perspective and for clients. But then again, the same where you've got individuals who are sole traders and they don't have to submit the tax return until the 31st of January following the end of the tax year, which is a long time from when there was the start of the prior tax year. So I can see where they're coming from, and Making Tax Digital has taken a long time to be introduced. I tried recording an MTD podcast probably about 2 or 3 years ago, at which point it had been deferred, but we thought it's coming down the track. And I have to say it was a very dry podcast, which we never released because we tried not to make listeners fall asleep. So it's trying to keep it as practical as possible. But you were saying that it's self-employed and landlords. Does it apply to all sole traders and landlords?
No, to start with, they're saying, right, you are only caught in this first year, i.e. from 6th of April coming up, if in the 24-25 tax year, your income was £50,000 or more. So I suppose that, I don't know what the statistics are, but it's taking out the really small businesses or rental properties. But that is the headline rent or turnover figure. That's not your profit. And then once they've eased us all in, that threshold drops to 30,000 and then 20,000 going forward at 12 months and 24 months. It is new, and it'll be interesting to just see how it works in practice, having talked about the theory for so long. And I remember very, very early on, HMRC produced videos of these things. They had, I can't remember, Bob the Builder. It wasn't Bob the Builder, but someone like that, sitting in a pub doing his records over a pint, just to emphasize this point of, well, if you keep your records right here, right now, they'll be more accurate than if you're, as you said, Leo, doing it 20 months after the event, because you just won't remember. So we'll see. So at the moment, £50,000 is that thing to remember. And we've been writing to clients, and I know HMRC have been flagging with clients. I think they were doing that in 2 or 3 waves. So we'll see how that works.
And I suppose the other thing that people might think, oh, does that mean I need to pay the tax? It's not. They don't need to pay the tax at all then. It's just more about declaring that income and expenditure.
So it is just that record keeping at the moment, and whether that changes, who knows, but we'll see.
I'm already thinking about my clients where some complications are arising where you've got multiple different owners of properties, different shares of the property. How are we going to report that? Because I think you only have to put one submission, isn't it? So I think it's per quarter. But then the other thing to think about is if, for example, sole traders, if they're VAT registered and they're already submitting VAT returns quarterly, then for them, this shouldn't be too difficult a task.
You'd hope not. You would hope that they're already in that headspace and that they're just cracking on.
Are there any exemptions that, so some clients who might think, oh, I fall into that, but is there any way I can defer?
An enormous list at the moment. And I guess this is perhaps the HMRC dipping their toe into it. So partnerships aren't caught. So when we talk about traders, it's sole traders, and that includes LLPs, which affects you and me, Leo, as partners in Safri's. Trusts where there's trust income, charitable trusts. You've done a whole list. I'm not going to bore people by going through the whole lot, but it's worth double checking. And then there are some for people who are digitally excluded. There are some for people who still claim the married couples allowance, which is now based on age. I was talking to my father has my father come up in these podcasts before? He's 98 next month, bless him. So we were having a conversation because he's very alert. He was asking me about the married couples allowance just last week, and that's an exemption. And I have power of attorney for him. He just brightened the button, but just in case I've got power of attorney, that's another exclusion. I suppose the thing to point out is just to say some of these are automatic, some of them you have to apply for. So if you've got any doubts, then speak to your tax advisor and they'll take you through the way the whole thing works. So some automatic. Your list goes on to a second page. Ministers of religion, lawyers, underwriters, blind persons allowance claimants. I think what they're trying to do is start gently, as I say, dipping their toe in it. And then I'm sure it will get wider than that. And the other point, as we were discussing this earlier, there's an exemption if you get a trust distribution, isn't there? So we were thinking about, well, if your sole purpose in life is to avoid coming into this, should you think about trust distributions that take you out with the new rules? Because it is going to be fairly onerous. No longer are you sitting there at Christmas starting to get that first niggle that you haven't done your tax return or sent us the information to do your tax return, and then you get into January and do it. With a quarter and then turn due for the first one by the 7th of August, peak holiday time, that becomes much more real, doesn't it? You can't defer it. And I'm sure that's part of HMRC's reason for doing it. So really interesting just to see how it lands. And I hope HMRC are relatively gentle with it in the first few quarters, because we're all sort of blind leading the blind, all in a bit in the dark on this, aren't we? Interesting times.
Well, I do think that when quarterly VAT returns were required, online filing for VAT returns, there was a bit of not an uproar, but there was a concern at that point. And now that seems to be running very smoothly. And I think it's all been helped. I mean, you were just saying about the man in the pub doing his accounts. With the fact that our mobile phones are so intuitive, plus all the apps, the Zero app on your phone where you take a picture of an invoice in it. There are other providers, obviously, and it will automatically post it to the right place. There are things that will make it significantly easier on the market, which...
Yeah, it's the oldies like me who'll struggle. Everyone else will be fine. And if you're reasonably tech savvy, I think you'll be okay. It's anything new, and it's taken so long to come in, this one, that that's caused a bit more objection. But I think a couple of years' time, people will be saying, oh, so what? That's just become the norm, hasn't it?
Well, as I say, the key takeaway for that is that if you think you might be affected, get in touch with your accountant to work out what you can do. And the other thing that you and I spoke about, and we talked about partnerships, where I have lots of husbands and wives owning rental properties, which they joined in a formal partnership. But if they were in a formal partnership, then they wouldn't have to report under MTD. So do you formalise that partnership? Because in effect, you really are in partnership already. Obviously, that needs to be thought about before the 5th.
Yeah, and there is a bit of advice around that, isn't there? Because the simple ownership of a property jointly, it doesn't create a partnership. So again, that might be something you need to sit down with your advisor to think about. I'm sure, just thinking about that, if HMRC are writing out to people, they must be just capturing what has been disclosed on tax returns. That will be the gateway to this, won't it?
Yeah. As always, Mike, interesting times.
We love it, Leo, don't we? We love it.
It's never a dull day, Mike. Never a dull day.
No, never, ever.
Hopefully you will have found this podcast useful. Before we finish, I just thought, in addition to the other tax year-end planning tips that you might want to consider, there's always the other useful things. For example, making sure that you've made the most of your ISA allowances. If you're making payments into your children's pension, stakeholder pension, have you made the contribution this year? Have you made the most of your CGT allowance? It's just thinking about those things to optimise those release where possible. Thank you, Mike. for joining me today. At Safri, we work with a wide range of clients, both in the UK and overseas. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. It's important for me to mention that if you're considering any of the topics discussed today, you must always take professional advice based on your own circumstances. If you'd like to find out more about the services we offer at Safri, then please do visit our website at safri.com. And don't forget to subscribe on your preferred podcast platform and leave us a review if you found this helpful. Thank you for listening.